Okay, so this is a brand new class this year. You guys are going to be the guinea pigs. I'm going to review this and adjust it a few times. So keep coming back and rewatching, and we'll get this right before next month's topics begin. For those of you that are new to us, there's a few websites that I want to make sure everyone knows about. The nonprofit website, fpfeaz.org, is the nonprofit organization that I run here in Arizona. On this website, you will be able to find a full class schedule, all the different topics we do. It's a different topic every single month, and all your opportunities to see upcoming classes. As well as register for them. We also post the class of the month on here for you to rewatch. And this gives you the opportunity to watch a recording of this class at your leisure. If you have not found our YouTube channel, we've got over 12,000 subscribers and over 250 videos. I put new videos on there every single week, so make sure you jump on there and subscribe and keep an eye on this channel. It's all little tiny mini classes, all 10 to 20 minute type videos. So lots of wonderful stuff on here on every little topic I can think of, because I got to come up with new stuff every single week. So lots of new content on there. And we also have collaborators. Grayson jumps on and does a market update occasionally. As well as our CPAs, although they're taking a hiatus right now, they're going to start adding videos. And then Chandler is going to start creating some videos as well. So lots of wonderful stuff on here. It's a full channel with lots of little videos. Jump on there and enjoy. Let's see. Our website, there's lots of great stuff coming. We just had a long conversation with the regulators and allowing us to put our full education on here. So the full video classes, we're working on formatting and getting those up on the website, which is sesweb.net. sesweb.net, that's our company's website. So the education tab is going to start getting filled up very quickly. We're authorized on our blogs now. We've got a bunch of reports we're working on putting together and downloadables like that. YouTube, this has a great little playlist organization on there. And again, those full classes and class schedules are on there. If you're looking for an appointment with me, you can always jump on yourinvestmentcounselor.com. You certainly could give us a call as well. But yourinvestmentcounselor.com is where you can look at our calendars and schedule 30-minute meet and greets or just straight to an hourly appointment. Our CPAs are on there, Grayson's on there, and myself as well. So always happy to accommodate and help out where I can, and that's what that is for. All right, so that's enough shameless advertising. Looks like we got a bunch that have joined. Again, this is being recorded, and we have everybody on mute until the end. I will open it up to questions at that point. All right, so tax efficient retirement planning. Those of you that know me know that I always do at least one tax class every year. Well, this year I broke that tax class into two tax classes, and this is a whole new version of the tax planning side. Last month, we focused in on the information about taxation that you needed to understand, how the tax brackets work, all the different types of money that you have, the rules for that money, all that kind of stuff. So we learned the basic knowledge we needed to know. And then the idea of this class is how to apply it to your situation. So hopefully I've put this together in a way to convey it in the most useful way possible. So let's jump in. The nonprofit organization is the Foundation for Personal Financial Education. That's the website, fpfeaz.org. Whole idea of this organization is to be able to do this financial education without the sales and biases you find out there in those wonderful dinner seminars and every other sales spiel you're exposed to. So hopefully you find this to be a different atmosphere and come back for more. And certainly come see me in person. I do a few classes, and I'm going to ramp those up after the summer and start teaching a lot more classes in person. My background, again, been running the Arizona chapter of the nonprofit for, well, I think 12 years now. I have a master's degree from University of Arizona focused in finance, and I own a local family of companies that includes a wealth management firm and a tax firm. So we do have practical working knowledge in virtually everything that we do education in. Legal disclaimer, everything we talk about in all of our classes is not direct financial advice. This is for educational purposes only. Please use what you learn in our classes to work with your CPAs, financial advisors, attorneys, whoever it is that you need to help apply this to your own situation. So the whole idea of today's class is really about efficiency. And I talk about this in everybody's case all the time. Efficiency, that's what a good advisor can do for people, is create efficiency. In this particular case, we're focusing on the tax efficiency of every individual's situation. And the idea is to lower your tax burden today and tomorrow. It's things going forward that we can affect the most. It's maximizing the amount of money that stays in your pocket instead of Uncle Sam's, and then maximizing the amount that gets passed to your heirs. Okay, so the agenda today, the idea of today, we're going to start out with a couple of quick, easy examples of what I mean by tax planning, the differences that it can make in individuals' situations. Then we're going to talk about what I think is the most important part, is honestly positioning yourself. We got to pull back 10,000 feet and say we got to understand how to position our money so we can help control the taxation. We've always got to start there. The vast majority of people I meet, we always jump straight to that. We've got to position this properly so we can control the taxation in our portfolio. Okay? That's always going to be the most important starting point, getting back to 10,000 feet and positioning ourselves properly. Then how do we start creating an income plan we can use in retirement? How do we start getting money in the most efficient way possible? And then controlling this flow so we can control the taxation. And then the end of the year maintenance, which this is the stuff that, a lot of people think there's so many little tricks you can do to avoid taxation. Well, look, there's little tweaks and changes you should make every single year, assessments you should make every single year towards the end of the year. And that's really going to help you. And then we'll talk briefly about that transitioning to heirs and things we have to think about there. So let's jump in. Why? This is a scenario I've used over the years because it really does hone into an individual type scenario that I find very common. When I talk about being as efficient as you can, this is very typical of things that can get tweaked here and there and save you lots on taxes. So here's a common scenario. I met this lady over in Sun City once, and it stuck out in my head significantly. She was over 65. Matter of fact, she was, I think, 80 something. And she was complaining that she just constantly, doesn't know how much taxes she's going to owe. Some years she owes nothing. Some years she owes 3,000. And she didn't understand it, and she lives on very little income, and it's very concerning to her. And this happened to be one of those years. The person that did her taxes told her she owed a little over $2,000, and she choked it. She's like, I don't understand this. I live on such little income. So in this case, she had $17,000 in Social Security, $16,000 pension, and then I noticed a 1099 with $9,500 in mutual fund dividends. And if you've heard me talk about mutual funds, one of the biggest problems with mutual funds is they're always buying and selling, and they'll sell right after they get the dividend and go buy a foreign stock, so then they can go find a dividend over there. They're mostly non-qualified dividends. They're mostly higher taxation, and these were being reinvested. And I asked her, well, you're living, a tight budget here on $33,000 a year. Do you not need these mutual fund dividends as income? And she said, no, that money is for my long-term care if I need it. Otherwise, I really want it to go to my son. So she doesn't intend on touching this unless she absolutely has to. So when I talked to her, I said, well, I can already eyeball it. I already see what's going on. It's pretty obvious to me. The Social Security calculation, when you're estimating whether you're going to owe taxes on your Social Security, you take half of the Social Security and you add all other forms of income. So that includes the 16,000 pension, but also those mutual fund dividends that are getting reinvested. Okay, that's still taxable events coming out of her portfolio in this case. This was not IRA money. This was not Roth money. This was just after-tax money she had saved and invested, and the mutual funds were kicking out the dividends. So we add all that up, and it adds up to 34,000. And when that number hits 34,000 for a single person, she owes 85% or taxes on 85% of her Social Security. So here's the hard part for her. She takes home 33, right? The Social Security and the pension, that's what she's living on. But in her case, she's paying taxes on 39,000. So 85% of Social Security, and then add in all these mutual fund dividends. So, you know, it lends to that perception issue. I live on such little income. Well, you're actually paying taxes on more than you even take in this case. So straight calculation with a standard deduction for someone over 65 is $2,516 or 2516, sorry. That's how much taxes she owed in this case. And to go from zero to owing 2,500 when you're only living on 33,000 is a big number. That's a shock at the end of the year that you don't like to see. So I showed her, you know, how to fix this pretty quick and easy. And the obvious change to me is this is invested improperly, and it's a sign of an absentee advisor or an advisor that doesn't understand what they're doing to their client. Because in a case like this, there's a million choices of how to invest money that don't include noise. I call it noise because it's money that is causing taxation that she's not using for her own income. There's plenty of ways to invest and not have those dividends being kicked out, not have interest, not have that noise, those taxable events. So whether it's moving to tax deferred, tax free, or tax advantage, which you'll see as we go through here, just adjusting which stocks you're investing in, getting out of a mutual fund and investing in an ETF or things like that. You can eliminate that noise and still grow your money, okay? So we get rid of that dividend portfolio, we adjust the investing in there. Now, all of a sudden, none of our Social Security is taxed. You go through that calculation again, and it says, nope, you're not going to owe taxes on your Social Security. As a matter of fact, she didn't owe any taxation at all because the standard deduction for a single person over 65 is $17,000 this year, and she had $16,000 in pension that was taxable, and that was it. So that saved her $2,500. And to somebody making $33,000 a year, that is a significant amount of money. So that is just a simplified version of what tax planning does in terms of becoming more efficient with your own situation. Everybody is in a different situation. So the other thing that I run into quite often, especially now, is the inheriting of IRA money, okay? Nobody knows the rules anymore. It's just a mess. It's very confusing. So I will go through some of this towards the end, but this is an example that I literally just ran into, okay? So client had passed away, kids came in, and it was one heir, one child, and they were married, okay? So they inherited $500,000 IRA. Okay, this married couple, this child that inherited this money, they had W-2 income of $100,000 a year. So it was a married couple making $100,000 a year. Now, I will be honest, the vast majority of people that inherit IRA money, they're woohoo, and they cash it out and they go buy a Corvette. So the unfortunate part, the irresponsible kids cash it out. They don't get advice, or they get bad advice. Okay, lump sum distribution for a married couple making $100,000 in W-2. If they take $500,000 and as a taxable event, they're going to owe $130,000 in taxes just on that $500,000. So instead of inheriting $500,000, they're really only getting $370,000. That's an enormous ding dong of taxation. I can't consciously allow anybody to do. It's ridiculousness. Now, can I say no, 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 and they still do it? Sure, of course. But the reality is people that don't have advice, or unfortunately, I'm seeing more and more often bad advice. That's the scary part, because they don't know the rules of inheriting IRAs. The rules say you have 10 years to distribute for vast majority of heirs. Now, there's some exceptions, and I'll make sure we know those at the end here. But the reality is the vast majority of your heirs or you will have a 10-year distribution window, right? There's no one saying you have to pull a 10th out every year. You may have small little required distributions in the meantime, but you got to have it all out within 10 years. That's another big problem. A lot of these people are just going to defer. And in the 10th year, instead of pulling out 500,000, they may be pulling out $1 million all at once. And that's even worse. We don't want to do that. So an even distribution over 10 years, the taxation, all things being equal, would be about 83,000. So certainly that's way better than the lump sum, right? If you keep making 100,000 every single year and you pull out a 10th of this every single year, you're going to cause 83,000 in taxation on that 500,000. Certainly I'd rather pay 83,000 than 130,000. But the cool thing about tax planning is everybody's in a different situation, and you can look at these individual situations. And in this particular case, in sitting down and talking with them and trying to figure out the most efficient way to withdraw this money, they said, well, with inheriting this money, and they inherited some other money as well, it was just the IRA that causes the huge tax problem. They said, with this money that we're inheriting, I think we'll be able to retire a little earlier. You know, a lot of current retirees' kids are going to be on that edge of retiring as the current owner of the IRA passes away. And so we look at that situation and we say, well, what if you worked for 5 more years and then retired? Okay, then you're going to have 5 years to distribute this money without that 100,000 in W-2 income. So we pencil out kind of the idea of the plan and how to fund retirement and do all of that stuff. And we realize very quickly that if we then distribute, we take 5 years and we don't touch it, and then 5 years we distribute it to fund our retirement. Holy cow, what a difference it made. You're eliminating that 100,000 in W-2 income because we wait till they retire. And now we distribute it within 5 years, and we've got only 39,000 in taxes. Okay, so very important understanding that we went from 130 in taxation down to only 39,000 in taxation. This makes enormous differences. And the hard part is that the baby boomers have tons of IRA money, and these heirs don't know how to handle this stuff. It's very important that they have help that understands taxation and can modify a plan based on their own specific situation. So certainly saving 90,000 in taxation is worth it, right? And that's the idea of somebody that understands taxation. And the planning side of it, because usually CPAs are way too black and white to understand the planning side of it. All right, so let's get to the important stuff. Let's get to where we have to start. Okay. Again, last month it was all about learning the information we knew. Now we need to figure out how to apply it. And positioning our savings becomes the most important part of this, because structurally you have to be flexible enough to control the taxation. And it starts with positioning your money properly. So we have to have an inventory. Okay, so important. Whether it's the financial planner or you have to understand your inventory. This is always where we've got to start. You start by divvying this up. You figure out how much IRA savings you have, how much Roth savings you have, how much after-tax non-qualified or trust account money you have, and then we can note the equity we have in our real estate. Okay, these are all different buckets of money. All right, we've got to understand those. Then I want you to go through your portfolio, figure out what you consider safe, stable investments, and figure out what you consider risk-based investments. This is good for you to do, because I've heard lots of people say, I think I should be somewhere around, say, 50-50. And then we actually do this and you're 70-30. Okay, so where do you want to be and what do you actually have going on in your portfolio? Important that we divvy this up, we figure out what we think we've got going on here and make adjustments as we need. Then I want you to figure out how much your guaranteed income is. This should be pretty easy. Most people know what their paycheck is every single month, but here's the harder one. Guess and then go find the real number. How much are your base living expenses? How much fund money do you need regularly? Okay, this doesn't talk about emergencies. This is, I take 2 trips a year, I golf this many times, I go to the movies, I go out to dinner. What's the regular fund money that you need on an average year? Sometimes there's going to be a bigger year. I get it. Average it out. Most people don't spend 100 grand on fund one year and then nothing, and then 30, and then 150, and then 2, and then most people, it's a little adjustments year to year, and that's about it. So inventory, start there. Very important. This is the beginning. Okay. Once you understand your situation, then we can start applying all the knowledge that we have. Because everybody's different, right? So I talk about this quite often. I talked about it in the last class, and then we have to start morphing it into how do we use it, right? Different tax classes come with different rules. So we have to treat these different tax classes differently, okay? First thing we have to understand is this after-tax non-qualified part of our portfolio. All that money that is not Roth and not IRA, we have to be able to control our taxation here. Everything we do comes with different tax consequences. So important we understand that. That first scenario that I started with, where the lady had these dividends coming in from mutual funds, those are big no-nos because those mutual funds, they're going to kick out lots of taxable events that you can't control. Quite often, their dividends are non-qualified dividends. They're short-term capital gains. They're buying and selling and buying and selling. We need to stay away from that stuff in this part of the portfolio. Don't use those robo-invested accounts that give you this separately managed account with a whole bunch of stocks in it, and they're constantly buying and selling and buying and selling with some weird computer algorithm. This is not the place in your portfolio for that stuff. Okay? That causes noise. Noise is taxation that's occurring that's not going in your pocket that you're using to spend in retirement. Noise is taxation that's causing you to pay taxes on money you didn't need. Okay, so let's reduce the noise. Understand that most of your investments are going to step up in value when you pass away in this part of your portfolio. Okay, so we've got to pay attention to this part of the portfolio more than anything else. And we're going to show you what we'll prioritize in this part of the portfolio. The rest of this is actually kind of easy. IRA money. IRA money, everything you do here is taxed at full tax rates only when you take the money out. Okay, once you retire, you know that you're going to have to look at that money and start pulling money out every single year for the rest of your life, because you're going to be forced to over required distributions. So if you don't get proactive and pull out before required distributions, your required distributions are much higher, which means there's less you can control. This is your heirs' least favorite money. You know, if you care about giving money to your heirs, you want to pull out as much of this as possible. There's no such thing as tax-exempt interest, long-term capital gains, qualified dividend, none of that. It doesn't matter. It doesn't matter how it grows. It's all taxed the same. Every time you take $1 out of there, you owe full taxes on it, period. There's nothing you can do to control the type of taxation coming out. It's always going to be full taxation. Roth, everything is tax-free, period. You pay taxes to put the money in there, but once it's in there, it's never taxed again. Growth or income with no tax consequences. Some of these K1 investments, we call them. The K1 is an ownership document, kind of like a W-2 or a 1099 type of investment where you own a piece of the company. It's an investment portfolio, but it's a structure that is different. And people hate these investments because from a taxation standpoint, over in your after-tax portfolio, you're sitting around waiting for these K1s because they have to file their tax return in order to create the K1 to send it out to all their investors. And guess when you receive it? Oh, about April 15th, if you're lucky. So the cool thing about Roth is you can invest in things like that. They're still good, usable investments, but people stay away from them because they hate that taxation. Well, Roth, you don't have to worry about the taxation. It's tax-free. The K1, no matter how much it says you owe in taxes, you owe nothing because it's your Roth account. This is your heirs' favorite money. So those of you that care about your heirs, you're prioritizing growth in here and you plan on giving it to your heirs. You're going to invest completely differently. You don't have heirs that you care about leaving money to, then you're going to want to maximize the use for yourself. Okay, everybody is in a different tax situation and we have to recognize that. So everybody's going to use each parts of these portfolios differently. Here's another scenario. Everything is taxed as ordinary income in your IRA. You have 20 heirs. You have it broke down into tiny little pieces to every single heir. Well, a mountain of money broke into tiny little pieces spread out over their 10 years. You might want to let them pay taxes on it. Your priority is now not to get the money out of IRA. It's to leave it as much as possible to them. Everybody's different, right? So when we look at these tax classes, we're going to start realizing that we're going to use them differently. Okay, when we look at our IRA, again, everything is taxed as ordinary income. So in every single scenario, this is where you're all common, you look at that money and say, how do I get it out at the lowest taxation possible? In my scenario of having 20 plus heirs, if they're going to pay less taxes on it, then I want to defer, only pull out what I have to pull out, and that's it, and let them pay taxes, because we are looking at this from that 10,000 foot saying everything is taxed as ordinary income. How do I get it out at the lowest taxation possible? Okay, that should always be the question you're asking every single year when you look at that inventory sheet and you see that pile of IRA money. Everyone should be asking that question. How do I get this out at the lowest taxation possible? That's a mantra that happens every single year, and we're going to show how to do that. Roth, everything is tax-free, right? So some of you are going to want to use this for yourself. Tax-free income, a high-yielding portfolio, kicking out lots of what I call passive income. Kicking it out, paying it to you, letting you use it while the principal's still there for withdrawals or heirs or whatever else. If you're going to try to maximize the use for yourself, this is a great little technique to use in your Roth. You maintain that principal, but you create a yielding portfolio, essentially paying out the profits to you without having to sell off any of the principal. Some people use it for strategic withdrawals. We'll talk about those in the flow of money and creating income and stuff like that, right? Roth, if I am going to start hitting higher tax brackets, but I need to go buy a car, I'm not going to pull from an IRA and get blasted in taxes. I might now need to use my Roth money for that. An emergency through a year where it's a higher tax year. And then growth for future, whether it's for your heirs, right? Some people look at this money and say, I'm never going to touch this. It's a great inflation hedge. Maybe you're going to hold off using it until you're in long-term care, or again, just give it to your heirs. So a lot of people look at this Roth and say, I don't want to touch it. Well, I don't want you to be that person that doesn't really have heirs they care about giving it to, and they never got to use it throughout their life. So for a lot of people in that scenario, you do this income yielding portfolio. So you're getting the tax-free income along the way, and then you keep the principal for later in life, the emergencies. Then there's that after-tax non-qualified portfolio, and every choice we make here comes with different tax consequences. So we want to make sure we're focusing on tax-advantaged income if we needed it, right? If we need some passive income, dividends, we need to make sure they're qualified dividends. Very important that we focus this portfolio on our needs, because if we don't need the income, we shouldn't be purposely maintaining a qualified dividend portfolio. Okay, there's no reason for it if we don't need the income. If we do need the income, great, wonderful. It's tax advantaged, it's passive. Sometimes it's a little more, sometimes it's a little less. I get it, it's all wonderful. But if we didn't need it, it's just noise on our tax return. So tax advantaged income is great if you need it. Emergency withdrawals. Again, that flexibility of pulling from an IRA when you're in lower taxation, pulling from a Roth when you're in higher taxation. Sometimes you can pull from your after-tax portfolio with little to no taxation as well. So maybe buying a second home, maybe an emergency car purchase, maybe a big vacation that you weren't expecting this year, whatever the case may be. This is also another place for emergency withdrawals. Again, we have to remember the step-up provisions. If we don't need the income, then you want to invest for growth. And long-term capital gains are tax advantaged, right? But we control those. We only cause those when we need to make those withdrawals. So if we need to make a withdrawal and we're okay with tax advantaged, we can make those emergency withdrawals over here. But if we pass away, all the gains step up their cost basis and we don't have to pay taxes. So everybody's going to invest this differently. If you don't need the income and you want to invest for growth, great. But you start putting this money in CDs and vast amounts in money market accounts and all this other garbage, you're causing much higher taxation for not too many reasons. You can be a conservative investor and want safe investments, but we need to make sure we know where to put those things. We're going to be pulling from the IRA every year. We're always going to lean safe investments over to that IRA first because it doesn't change the taxation. If I put safe investments in over here, they're mostly interest bearing and they're going to cause higher taxation. Okay, so I'm not saying don't put any money in money market accounts or CDs. I'm saying let's not use that as the primary strategy over here. Let's not have exorbitant amounts of money sitting in this part of the portfolio earning interest. We're trying to be as efficient as possible. I see people have their dividend portfolio in their IRA and then a whole bunch of CDs and their after-tax money, and I'm just like, well, this makes no sense. You need the safe, stable investments over in your IRA because that's where you're withdrawing from every single year. Let's put the dividend portfolio in the after-tax portfolio so we can adjust the taxation and make it more advantaged for you. So we've got to understand those piles of money that you have. And so when we go through this, we need to carve up the portfolio in a thoughtful way, making sure we're structuring this properly. Okay? You address your income, make sure that income's paying those base living expenses. And we'll talk about that in that income priority list. Then we need to have 1 year's worth of fund money and a cushion for that unexpected expense in cash. That's where your money market should be, right? Just 1 year's worth of money that you need above your income. This is not the emergency account that needs to be there in case the world comes to an end. This is not in case you get cancer and you need to travel to a foreign country to get a procedure done that you can't get in the US. This is simply the amount of money you need above your income for the year, plus a small cushion for an emergency like a heater or air conditioner going out or a car breaking down, things like that. Reasonable amount of cash. Okay, then once you have this taken care of, you know that your income is going to pay your base living expenses. You got the extra money in your bank account to enjoy the year without having to worry about constantly pulling from your investments. Now we go to invest the money, and here's your rules that you're going to live by here. You have safe investments versus risk-based investments. Very important. Safe, stable investments versus risk-based stock market type investments. Here, it's very simple. This should encompass everyone right here. The number one priority of a retirement portfolio is to have the ability to withdraw in good or bad markets without withdrawing from a loss. So if you don't need your savings, if you live on your income and that's it, if all that's in cash is really just an emergency in case you have a bigger month, but your income pays more than your bills and you're still in savings mode, then all your money can be in the stock market. You don't have to worry about withdrawals from there, right? So this should encompass everybody. And I say this because the whole idea of safe investments is so you can make a withdrawal without pulling from an investment that lost. But I do recognize we have emotions, and some people want safe investments. I'm fine with that. There's nothing wrong with that. That's fine. You can sleep at night. You can put as much safe investments as you want, but this is a need. That's a want. Okay? It's that simple. If you want to be as efficient with your portfolio as possible, the only reason you need safe investments is so you have a place to pull from when the stock market's not doing well. Because if you don't have to pull from the stock market when it's going up and down, then it's just turbulence. If you do have to pull when it's down, those are actual losses. We want to avoid that. So the higher your dependence on your portfolio for income, the less it should rely on market performance. The more stable investing strategies that you need, right? The larger your withdrawal rate, the greater the effect of volatility. You start hitting 4, 5, 6%, you cannot have a volatile portfolio. You need a lot more safe, stable investing. Okay? So this is important. We carve this up for every person out there. You've got to have the flexibility to pull from each of the 3 classes. You have to have the flexibility for pulling from a stable investment versus a stock market investment. So structuring this for every individual is so important. We've got to have the right mix in here so we have the flexibility to handle the future that we don't know exactly how it'll come out. So how do we do this? How do we create this income plan? How do we know how much of what to put where? Well, when we go in and look at income types, there's going to be 3 different types of income that you're going to fund your retirement with. Okay? Guaranteed income. This is a paycheck that comes in whether I have money or not, right? You depleted all your savings, it's all gone, but you still got that paycheck coming in. So that's that pension, Social Security, and those income annuities that have been triggered that are paying you the payment for the rest of your life. Then you have passive income. Passive income fluctuates year to year and is not needed to pay the light bill, right? You don't want to have to rely on a dividend portfolio, okay? Or interest from a CD, because that CD is going to mature and then you're subject to whatever interest rates are available out there. We all like these higher interest rates, but higher interest rates also come with inflation. So the reality is that dividend payers, interest payers, yield portfolios, we're not trying to rely on that to pay the bills. Unless we have millions and millions, if we're Warren Buffett, billions of dollars, and all we need is a few dollars. Okay, I get that. There's plenty of retirees out there that have millions of dollars in dividend portfolios, and they really only need a few $1,000s out of there. Perfectly fine with that. That's a passive income. You got enough guaranteed income to keep you comfortable, and then plenty of savings, 1%, 2% withdrawal rates. You can have passive income take care of the rest. Everybody's different. Then there's withdrawal income. Okay, excess money needed above passive and guaranteed income, right? This is those one-time bigger withdrawals. At some point, your RMDs get bigger than passive income. They start close to 4%, it's 3.6 and moves up every single year. You start hitting 5, 6, 7%, you're gonna have a hard time getting yielding portfolios, yielding investments to give you enough out of there. So now we gotta start selling those investments. That's when we're buying cars, the bigger vacations, so those periodic withdrawals that we have to make out of there as well. So we have to look at everybody's individual situations and look at the most common situations and say, well, you can run 99.999% of your retirement off your guaranteed income and a little bit of passive income, but we have to be ready for withdrawals for that future car and when the RMDs start getting bigger. That's the vast majority of people in retirement. And we have to know that investing is different for each one of these types of income. Okay, so you go back to that basic budget, you understand what your need to pays are, you understand what your want to pays are, and then you understand those withdrawal emergencies, right? I need a car, what are your insurance deductibles? I carry very high insurance deductibles on my house my house burnt down, I'm sure it's a $10,000 deductible on there. Car, some people hold higher ones. I think the highest they let me now is it's like $3,000 on a car. Some people's children are the big emergencies. I've heard some doozies. And certainly long-term care, we want to have a plan for that. So we fund that budget. We have to know what we're dealing with. What is this budget? But if we're going to be efficient with our portfolio, if we're going to pay the least amount of taxes, being efficient means paying the least amount of taxes for our situation, not just today, but over the life, especially of that IRA money. Okay. So guaranteed income should be paying your need to pays. You should try the best you can to structure your retirement with need to pays that are covered by your guaranteed income. Passive income, want to pays, right? Those dividends, the yield, the interest you're getting, that's for the fun stuff that our income didn't pay for, okay? Some of you have big incomes and they pay for the I want to pays too. I'm fine with that. I'm okay with that. Just less money that we need there. And then the withdrawal income, want to pays and emergencies, right? We don't need a car every 2 years. We want a car every 2 years. Whatever the case may be, we have emergencies, we have I want to pays, those are the withdrawals. So we have to recognize what we can control and can't control. Taxation and controlling taxation comes down to this. What can we control and what can't we control? Right here, you can't control Social Security and the amount of taxes you're going to owe on your Social Security, right? You're not going to call Social Security and say, you know what, pay me a little less. I didn't need it. No, that's not how this works. Your pension pays what it pays, and you're not going to avoid the taxation on that. Triggered income annuities. You can certainly control how much you put into income annuities, but once you trigger them, it's a payment to you for the rest of your life. You're not changing the taxation on this once it's done, okay? So I'm a big fan of these I can't controls covering what you spend on a regular basis. But here's the thing. People constantly say, oh, more income's always better. More income's always better. Well, I've seen people with $10,000, $15,000 a month in income, and they're only spending $6,000 or $7,000. They're paying taxes on all this extra income that they didn't need. Is that efficient? No. Do they feel comfortable? Yes. But if they only had $6,000 worth of income because they spend $6,000 of income, they'd be a heck of a lot more efficient. So we have to understand that. We don't want to go out and throw a whole bunch of money in these dinner seminar income annuities because more income's better and you trigger it all and you feel great, but then you're paying taxes on all this extra money for no reason whatsoever. It's just not very efficient. You can be just as happy and keep more of it in your pocket, okay? So then what can we control? Well, certainly how much money you're going to put in those income annuities is obvious, but things like your choice of withdrawing from an IRA versus a Roth versus after-tax money. When you go to that withdrawal income, we have to strategically know where we're going to do this, and we have to have the system in place so we can control this. Because if you're haphazardly pulling throughout the year, you're never going to be able to control efficiently where you're pulling from. So we have to have a system in place so we know when to pull from an IRA, when to pull from a Roth, and when to pull from your after-tax portfolio. Dividends. Dividends coming out of your portfolio. That noise when you didn't need the income. Dividend portfolios are great. Everybody should have dividend portfolio. Well, no, not necessarily. If it's causing a bunch of taxation and you didn't need the income, I don't know why you have the dividend portfolio. There's plenty of ways to invest that don't cause that taxation. Okay, so dividends, qualified versus non-qualified versus none, right? Capital gains, long-term capital gains versus short-term capital gains versus none. In your after-tax portfolio, we can control this. Roth and IRA, doesn't matter. Interest. I can choose to take my after-tax money and go throw it in a bunch of CDs or corporate bonds or money market accounts. I can choose to do that, but I'm causing a bunch of taxation. I can also choose to use my IRA and do that and then put the dividend portfolio in over here. So we have to look at what we can control and just have a good system to do that. So types of taxation, tax advantaged. Well, that's qualified dividends. Qualified dividends are U.S. stocks that you buy and hold. You buy and hold those stocks, they pay out the profits in the form of dividends, and you get lower taxation. Okay? Long-term capital gains, buy and hold for a year. Okay? That's a long-term capital gain versus buy and sell within a year, you're going to owe full taxation. So you can control these things. Tax-free, well, Roth, any withdrawal you make from a Roth is completely tax-free. Municipal bond interest is tax-free. We have to know what we can do to create tax-free income in certain situations. Tax-deferred, IRA, anything you have in an IRA is tax-deferred. You'll be forced to take some money out once you reach 73 or eventually 75 in the form of a required minimum distributions. But while it's in there, you can buy and sell and do whatever you want until you pull a dollar out. There's no taxation. Annuities are tax deferred. If you want safe, stable investments that aren't causing taxation in your after-tax portfolio, you could buy an annuity, and whether it's a fixed or variable or a MYGA or a fixed index, there's lots of different types of annuities out there. But the reality is that money grows. And especially in a MYGA's case, that's just like a CD, and you don't get the taxation. So if you're in the higher taxation brackets and you don't want that taxation and you're okay passing it to your heirs, then hey, there you go. You can grow the money safely. Go for it. Full taxation. Well, all your can't control income, up to 85% of your Social Security, your pension income, depending on what kind of money you use to buy the income annuity, can't control income, you're going to get hit with full taxation. IRA withdrawals. You pull money out of your IRA, you got to pay full taxation. Interest, you're going to pay full taxation. Short-term capital gains and non-qualified dividends. These are all full taxation. So we have the buffet here. We can handle whatever's thrown at us if we know when and where to use what. So here's what we do. We look at that portfolio, we look at your inventory, we figure it out. We say, okay, what do we focus on when? Well, if we know your budget, we know how much income you need. So in this area here, for people over 65, single or joint, that big thick line right there, 12% taxation. Most everybody's okay paying 12%. The next tax bracket is 22. It's an enormous jump in taxation. That's 10% extra in taxes. So when you're within 65 as a single person, 130 as a married couple, this range is okay to have full taxation. That's where your income you can't control. You want it to stay within these numbers here. That's when I'm okay with you paying in taxes on interest. IRA withdrawals. You want to fill this up every year, right? So full taxation, we're okay with it, 12% less or less. But then when you start going over 65,000 as a single person, when you go over 130 as a married couple, that's where the tax advantage and or tax-free comes in. That's when we start needing qualified dividend portfolios. We want to make sure we have long-term capital gains versus short-term capital gains. Maybe we start using a little bit of municipal bonds and Roth withdrawals. You look at your situation and say, well, I'm a married couple with 120,000 in regular income that we have to pay taxes on. I have an extra 10,000 that I can pull out every year, but I needed 30. Great. Pull 10,000 out of the IRA, 20 out of the Roth, and you're good. You never had to pay 22. You see how we make these decisions? So important that you have this chart in front of you every single year. It adjusts a little bit every year. 2026, right now, 10 is going to 12, 12 is going to 15. Let's see, no, 10 is staying 10, I think. 12 is going to 15, 22 is going to 25, 24 is going to 28, and there's a few other adjustments. So we have to make sure we have this in front of us every single year. This is going to help us make better decisions. Right? When we structure our portfolio, we need to have an idea of this, how much income we have, how do we control all this? What parts am I going to do this? Well, if I've got a high income that pushes the top of this, then my after-tax portfolio, I'm going to start being a lot more careful on. I don't want the interest-bearing investments in my after-tax portfolio. I want the qualified dividend portfolio. Okay, so important that you have this in here as you're trying to structure your investment portfolio. Then, for those people that are lucky enough to be in the 30+% tax brackets, look, more money is a good thing, right? But you're being forced to pay a much higher tax rate. And that's where defer is what your mantra is. Take the absolute minimum out of your IRA that you have to, the required distribution. Consider the tax deferral tools like annuities, things like that. Push the taxation to your heirs the best that you can. So, part of creating this income and structuring your portfolio is understanding how you can control the flow, because too many people go through their year and instead of using that bank account as the cushion between their investments, they leave their bank account alone because they get nervous if they don't have 50 grand in there or 100 grand or 200 grand. I've seen people have obnoxious amounts of money in there and still go straight to their investments all throughout the year and pull and pull and pull and pull. You're never going to control your taxation. You're never going to be efficient doing that. Period. Don't do it. Please. It's so important we understand this flow. Okay? So you have a checking account. That's where all your regular income comes in. That's used to pay your bills on a regular basis. Then I want you to have a savings account that has 1 year worth of spending money. Okay? Plus a cushion for an emergency. You can look at this once a year, not every week, not every day, not every 5 minutes. We're going to refill this once a year, and you're always going to do it towards the end of the year because you're always going to have an idea of what your next year looks like, how many vacations you're taking, if you're going to need a new car, all those wonderful things. The whole idea of this is to help control the flow and help you make better decisions throughout the year. Okay? Once a year in November, we're going to pull from safe investments when the stock market's not doing well. We're going to pull from the stock portfolio when things are going well. That's the hard part, right? Pull from the stock portfolio when things are going well, right? When the stock market's going up, that's when you're going to start taking some of those profits out of there. And then certainly the equity in your houses are there for the end of life type emergencies. When you're moving out of the house, you're selling it, you got all that extra money laying around. So all you're saying, I don't know why I have to tell this to people. It's amazing. We spent most of our lives saving this money saying, I can't touch it. I can't touch it. I can't touch it. And so there's this stigma about all this money you have saved. When once you retire, once you're over 59 and a half, every penny you have is just an extension of your bank account. Don't think your bank account has to sit there and always have 100 grand in it or always have 50 grand in it. That's not reality. You have access to 100% of your money all the time. You can do it. It's okay. So I want you to use that savings account throughout the year and then refill it at the end of every year. It's that simple. Okay? All of your savings is just an extension of your bank account. You don't have to have that emergency money. You can still have an emergency and go pull from your investments if you need to. An organized way to keep track of and control your taxation, right? If you're not constantly dipping in, pulling throughout the year, and you're only focusing on refilling that bank account once a year, you can make much better decisions. And you should, for the most part, know of all the big taxable events from the year, right? You should know how much Social Security you got, how much pension you got. If you have any of those income annuities paying you payments, you should know tax it because it's the same every single year, right? If you made an IRA withdrawal, you know it's all taxable. And then the little bit of noise that you invested properly, you should know how much noise you have coming in. You're going to make better decisions on where to pull from. Remember, when you have that chart of the taxation and you know where your income is, you know when to pull from where. So you're proactively preparing for the upcoming year once a year by refilling that bank account and using it throughout the year. So the other way we look at this, to refill that savings account every year, we're choosing to pull from our IRA versus Roth versus after tax, right? So our required distributions and strategic withdrawals are coming from the IRA. right? If I'm in the 10 and 12% tax bracket, then I want to pull from my IRA. I want to choose to pull from there. So if I need money to refill my savings account and I still have room in my 12% tax bracket, I'm going to pull from the IRA first. It's always the place we go to first if we're in the 10 and 12% tax brackets. Then, if it's pushing us over that 12% tax bracket, I have my after-tax and Roth money to pull from. Roth is tax-free. A lot of the times we'll create passive income from there or strategic withdrawals. Non-qualified tax advantaged income, passive income, right? Dividend portfolios are tax advantaged there. And strategic withdrawals. These are all strategic withdrawals, meaning we know when we got to pull from each part of this based on where we're at in these taxation. If we have to pull from our after tax and it's only going to be a long-term capital gain and we're okay paying 15% because we're low on Roth, we don't have much Roth left, or maybe our priority is to give the Roth to our heirs, then the tax advantaged helps in the non-qualified portfolio. Okay. So once we have this structure in place, this flow in place, we're controlling our taxation better. Now we're going to have to do some tweaks every year. That end of the year review, we go through our inventory and we take a look at our income for the year. We take a look at how much we have an IRA, Roth, all that stuff. We need to start figuring out what we're going to do. Towards the end of the year, all your charitable giving, right? QCDs are so important, qualified charitable distributions. If you have a required distribution and you don't need it for yourself and you're charitable, you give from your IRA and that's it. You got to give all your donations directly from your IRA. In Arizona, we have tax credits. Instead of paying the taxes to the state of Arizona, you can hand it to a charity, you get a dollar for dollar credit. And then there's some bundling of 2 years. So, all the funny commercials about bundling, bundle-a-rooski and all that stuff. Here's the thing. If you have a year where you've got tons of medical expenses and you know you're going to itemize, there's lots of things that you can pay for the next year. You can prepay property taxes. You can, if you have a mortgage, you could at least make your January payment in December. There's a lot of things that you can do on top of donations to charities. You could donate, do your donating for next year, this year. So you pile in as much as you can into 1 year, itemize a whole bunch of stuff, and then take the standard deduction the next year. Then I want you to review your tax loss harvesting. So this only applies to those of you that are with a whole bunch of after-tax non-qualified money. Okay, so the after tax or trust money is maybe your trust account. This is your investments that's not IRA and not Roth. At the end of the year, if you have a position that is down $10,000 and a position that's up $10,000, you could sell both and they'll cancel each other out. There's no taxable event. Okay, very important that this maintenance goes on every single year, little tweaks every year when you're managing a big after-tax portfolio. If you're doing this year to year, you're going to have a lot less capital gains in there when you go to need money. When you say, oops, I needed to make a withdrawal, then you won't be hit with as much taxation. You're being proactive. You can also have up to $3,000 in losses cancel out other income, meaning if you had a $15,000 loss position and a $12,000 gain position, you sell the two, you still have an extra $3,000 that shows up on your tax return and cancels out $3,000 of your income. Can't do more than $3,000. So fun little thing. You should be doing that every single year if you have after tax. This does not matter when it comes to your Roth account or IRA account. It's all your after tax, and really, for the most part, you got to be invested in the stock market. Retirement contributions. If you have a little part-time job, a little fun gig, little side hustle, they call them, you can still, no matter what your age is, deposit into an IRA or a Roth, but you have to have earned income. W-2 or profit from self-employment. And then you can contribute to an IRA or a Roth account $8,000. Again, you contribute to Roth when you're in that 12% or less tax brackets. You contribute to an IRA if you're in the 20s or certainly the 30s. Withdraw your RMD, please. It's no one's fault but your own. The investment companies, the advisors, nobody's allowed to take money out of the account without your authorization. You're the only one that's allowed to take that money out. You can pre-authorize it for them to automatically send it to you every year, but it's still your responsibility, so make sure you're doing it. If you were born between 1951 and 1959, you start at 73. I do a whole class on required minimum distributions, usually August, November, I think is when I do that class. 75, it begins for people that are 1960 or later. If you fail to take your required distribution, it's a 25% penalty. Now, they reduced it from 50, so they're actually going to start charging it now. And the value of your IRA money, collective, all of it on January 1st, technically it's December 31st of the previous year. So the value of your money at the beginning of the year, it's going to be your age at the end of the year. And then there's a chart with the IRS that you use to calculate it. Very important. You are the only one responsible for taking your required minimum distribution. A good advisor is there to help, but they can scream and scream and scream. I've had clients that 30 phone calls deep, 20 emails deep, no response, no response, no response. So you got to be careful about that. Roth conversion reasons. Here it is. This is the big one. Almost everybody, I said almost everybody should be proactively doing Roth conversions to some extent every single year. Choosing and controlling the tax rate to pay on your IRA savings. That's one of the reasons right there, right? I want to control how much taxes I pay on that IRA money. I'm going to choose to pay the least amount of taxes possible. Avoid or reduce required minimum distributions. If you are age 59 and a half on up to 73, you should be proactive, withdrawing the best that you can at the lowest tax rates possible. This will reduce how much you're going to have to pull out in the required distribution phase. Hedge against higher taxes, right? If taxes go up, for instance, next year, if the 12% tax bracket turns into 15% and you chose to pay 12, you're avoiding taxation at 15%. It's that simple. You got all this IRA money. How do you get it out at the lowest taxation possible? Avoiding IRMA. What if you do nothing? Your Social Security income, your pension income, and now this huge required minimum distribution starts coming in, and it pushes you into higher tax brackets and makes you pay more for your Medicare premium. Okay? Make sure we're proactive. Make sure we're limiting how much of that IRA money we're going to be forced to pull out. Reducing taxes passed to your heirs. Your heirs hate this IRA money and they don't know what to do with it, and they're all making mistakes. Increase control over taxation in retirement. Well, that's the whole name of the game here. And then for you aggressive investors out there taking advantage of a down market or position. Imagine timing this perfectly. The pandemic, we had about a 40% slide in 1 month. And then it rocketed 80% after that. At the bottom, if you took a whole bunch of IRA money that just lost 40% and moved it over to your Roth, you paid taxes on it, and then that Roth money grew all the way back 80%, yeah, that was worth it. Even if you had to pay some 20% taxes because you got a 40% discount because the market was down so much. So I saw people doing this back in 2008. It made sense. There were reasons to do it in more aggressive situations. I certainly did a lot of it in the pandemic. But anytime you see a big pullback, you should be looking at your portfolio and saying, well, I mean, it's a good time. Let's see if we can take some money from that IRA and move it over to my Roth. All right. So how do we do this? How do we know how much we should be converting every year? Well, everyone is going to use a different bracket. So I'm going to use the 12 because this is what the vast majority of people do. Certainly, there's lots of people doing it in the 22% tax bracket, the 24% tax bracket, but none of you should be doing it in the 30+% tax bracket. So here we go. If you go look at the tax rates, you Google the tax rates in the IRS, the top of the 12% tax bracket for married couples is $96,000 in 2025. For single people, it's $48,000. But we all get the standard deduction, which whether you like it or not, most everybody takes the standard deduction. Itemizing is dead and gone unless you had a really big medical year. Standard deduction for a married couple is $30,000, $15,000 for a single person. But if you're over 65, each of you, when you're married, get $1,600 extra. And if you're single, you get $2,000. So that's a total of $130,000 room in the 12% tax bracket. Once you go over that, you got to start paying 22%. Single people, that's 65,000. So now what do we do with this number? Okay, we start with that number and we say, okay, let's start subtracting our income. Up to 85% of your Social Security is taxable income, so subtract it. Subtract any pension income. Subtract any interest income. Subtract any other form of income, including qualified dividends and long-term capital gains, if you want those taxed at zero, right? We subtract all this, and what we are left with is how much we can withdraw from our IRA. So it's very simple. Let's say you're a married couple and you have $100,000 worth of income. You subtract $100,000 from 130, and you're going to end up with $30,000 that you can convert from IRA to Roth at 12% taxation. It's that simple. So we need to know this number for every tax bracket, and it's that simple. At the end of every single year, you add up what your income was for the year. You look at this little bracket right here. Green means go. Blue, gray kind of means maybe. Red means stop it. Defer, 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 right? So the top of the 12%, if you had less than 65 as a single person, less than 130 as a married couple, you know you can do a Roth conversion that year. If you're pushing into the 20, 22, 24, you got to start being careful of IRMA. This is where the IRMA adjustments come in. Okay, I talked about it as a shadow tax in the last class. If you are pushing into these 22 and 24 tax brackets, that's where you got to worry about IRMA. If you're in the green, you don't have to worry about anything. You're good to go. Okay, you're going to use these numbers and they're going to adjust every single year. This is 2025 right here. You're going to use these numbers and you're going to look at this at the end of every single year. You're going to adjust your portfolio every year. If you have a $150,000 income need as a married couple, need as in your enjoyable retirement on average costs you $150,000. Well, then we know we're going to be subject to 22 unless you know what you're doing. All the full taxation type investing and income should be handled within 130. Now we need 20 more thousand. So qualified dividends, long-term capital gains, withdrawals from Roth, you've got municipal bonds. These are all things we can use to create that extra 20,000 in income and still pay only 12% or less, right? That's the magic of this. When we see these numbers, when we see these brackets, and then we tweak every single year, we do this little exercise every year, we make sure we are maintaining the efficiency that we need, okay? Pay what you're supposed to, but not a penny more. So when it comes to your heirs, this is all very confusing. The first thing is the vast majority of us don't have to worry about estate taxes, or do we? A lot of people have had a lot of growth for the last couple of years, and we have to remember our current exemption is $6 million, not 13, $6,995,000 times 2. We are temporarily doubled right now. That is set to expire next year. We all think they're going to extend all this stuff next year, but it is set to expire next year. So if you think you have a $13 million exemption, you really only have $6,995,000 next year, unless they extend it. So just know we are under temporarily doubled exemption. And what does this mean? Well, if I have $13 million and I die and I give it to my heirs, I don't have to pay the estate tax. But if I have $14 million, then 10,000 of it is going to get taxed at 40%. If I have 50 million of it, whatever 50 million minus the 14, I have to pay 40% taxation. It's whatever over. The exemption is the first $13.9 million. Okay. Portability means you and your spouse have 13.9 each. Combined, that's 28, call it 28 million. If one of you passes away, there's a form to file with the IRS and you get your deceased spouse's exemption. So you are effectively doubled for life, which means right now you're quadrupled. Yes, confusing. So here's the thing. A lot of people, I don't have anywhere near 13 million, but then I start saying 6, 7 million and they're like, ooh, I'm getting close. Okay. So if you're getting close to that 6, 7 million, you got to pay attention. If you're way under that, you don't have to worry about estate taxes. The annual gift exclusion. For those of you that are pushing that $6-7 million net worth, you should set up separate accounts for your heirs. Maybe you got 4 kids, you set up 4 separate trust accounts and you start gifting $19,000 each into it. And if you're married, that's each of you gets to put $19,000 in there. The whole idea is to keep your net worth below that ceiling. Okay, so you can gift and not report it to anybody. You give $1 more, you got to report it to the IRS and it reduces your lifetime exemption. You want to avoid that. That's why you stay within the 19,000. If you have real estate in any of these states, okay, and really what matters most is your primary residence. What address does your tax return have on it? What address does your driver's license have on it? I can tell you there's a handful of states. I have a simple solution for you. Get out, right? The handful of states are very easy. If you're over 4 million, it's Washington, D.C. If you're over 5 million, it's Hawaii. Over 4 million, it's Illinois. Iowa, we believe, was repealed. We're still waiting on the results of that. Kentucky, just get out. They have a weird inheritance tax. Maine, if you're over 6 million, Maryland, just get out. They not only have an estate tax, they have an inheritance tax. Just get out of that state. It's a terrible state to die in. Massachusetts, if you have more than $2 million, which is the vast majority of Massachusetts, whatever they call themselves, you're going to have to pay taxes on all of it over 2 million. Minnesota, 3 million, get out. Nebraska, just get out. New Jersey, just get out. New York, over 6 million. Oregon, over 1 million, get out. If you have over 1 million, you should not have that as your primary residence when you pass away, because when it's your primary residence, they get to take their tax from your entire estate. If it's just a second home or an investment property, they only get to tax what's in the state. Pennsylvania, get out. Rhode Island, get out. Anything over 1.7 million, get out of there. Vermont, over 5 million, and Washington State, over 2 million. Get out, get out, get out. Just don't have your primary residence there. Go to a state like Arizona that has no estate tax. Do your taxes with that address. Do your driver's license from that address. You can still spend time in these other states. I'm not saying don't. I'm simply saying don't make it your primary residence. Then, when we talk about the heirs, we got to keep this into perspective, and this includes your decisions on your IRA. If you care about what goes to your heirs and you have lots of heirs, you're going to take a big pile of money and make it a whole bunch of small piles of money. When we talk about taxation, a big pile of money is going to have more taxes than a whole bunch of small little piles of money on separate tax returns. So we have to look at that bigger picture and keep that in focus when we're making decisions on pulling money out of our IRA. If you have a whole bunch of heirs, maybe you want to be less aggressive with your Roth conversions and other things, okay? Then when your heirs inherit this money, there's a few exceptions to all these rules. Spouses, they can inherit their spouse's IRA money and treat it as their own. So they get a special deal there. Minor children, chronically ill, disabled, and your siblings, people that are less than 10 years younger than the original owner. Weird little category here. They all get special rules. They get required distributions and no 10-year distribution rule. Okay, so those are the exceptions. Everybody else, which is the vast majority of your heirs, is everybody else has up to the December 31st of the year that is 10 years after the original account owner's death, which is very hard to keep track of and makes most people go cross-eyed. Okay, There may be RMDs still required, and this applies to all your pre-tax IRA 401k savings as well as Roth. Now, Roth, when you withdraw, there's no taxation even for your heirs, but they still have to have this money out within 10 years. So what do? Well, the first thing they want to do is kind of pencil out a worksheet. They want to have this tax brackets in front of them with the standard deduction on there. And that's where it is for people under 65 right here. And then you want to kind of pencil in, well, what do you think your income is going to be each year? Are you still working? Are you retired? What's this income look like for the next 10 years? And then we have to figure out how much money we are going to distribute and what's the most efficient way to do it. It's pretty easy to do once you understand someone's situation, okay? They've got to make the right decisions. So they need resources, they need somebody to walk through this with them, or they need to be a CPA or a financial advisor of some kind to understand it. Those are pretty much the only people that understand what to do at this point. So make sure your financial advisor understands your whole situation and pays attention to the taxation they cause. This is my biggest pet peeve in this industry. Advisors that say they can't talk about taxation should be booted. They should just lose their license. There's nothing, everything they do, every choice they make in your investment portfolio is causing taxation to you, not to themselves. So they've got to understand this. That's not fair. Investing in your after-tax non-qualified part of your portfolio is different than your IRA and Roth. This is where we can control the taxation. Maximize that 12% tax bracket between 59.5 and 73 to avoid higher taxation later in life, right? Always keep an eye on the bigger picture. If you are charitable and over 70.5, donate directly from that IRA. That's the only way you should be donating, because effectively you're getting the standard deduction and you're getting the benefit of that charitable contribution on top of that. Otherwise, you have to itemize it. You're not going to get very much benefit out of it. Think about your heirs' tax brackets when they inherit the IRA. A lot of people think, oh, they're in there making lots of money. Well, they may be retired by the time you give them your money. So think through this and let's make wise decisions. Systemize your end of the year review. Once a year. You don't need to look at it every week or every month or every quarter. No, once a year. Sit down in November, December time and go through this. Look at how much money you need for your bank account. Figure out where to pull from. Figure out if you need to do a Roth conversion. Figure out your charitable contributions. In November, December, you should sit down and do this once a year. So, achieve balance. Review the location of your assets across your taxable, tax-free, and tax-deferred accounts. Okay? Provide that withdrawal flexibility. When I say withdrawal flexibility, be able to pull when the market's doing well and when it's not. That's important. Make sure we have the right investments for you. I use Hershey's stock versus Coke stock. Hershey's is buying back their shares instead of paying dividends, creating more value, long-term growth, right? Whereas Coke pays out all their profits in the form of dividends. Well, that causes taxation. If you didn't need that income, then you should own Hershey's. If you do need the income, then you have the dividend stocks like Coke, all right? Or capital gains versus dividends, or corporate bonds versus municipal bonds. All these things we can control. We need to have the right investments for our own situation. Choose the right investments for the right type of money as well. I don't want to see a municipal bond in your IRA or Roth account. There's no reason for it. It doesn't make any sense. It's a great example of an investment that has a niche. It's a niche that is only in your after-tax portfolio, okay? It becomes tax-free at that point. It's useful. Otherwise, it's not useful at all. So make sure that our IRA, we recognize we're going to pull from there every year and have a plan for that. Recognize that it doesn't matter whether it's a qualified dividend, a interest, or a short-term capital gain, or any of that. It doesn't matter. Roth is tax-free no matter what. We do need to control the investment choices in that after-tax portfolio. Create an income plan that covers your bills. If you have a whole bunch of extra stuff you're paying taxes on for no reason whatsoever, then you're not being efficient. Okay? We have to understand our budget. I'm not telling you have to be strictly adhering to your budget unless you have limited resources. But in order for you to be as efficient as possible, you need to understand your budget, what you are regularly spending, and then know where you're going to pull from when you need more than that. Manage your losses. If you have a big after-tax portfolio, you do need to understand taxation, and you do need to be proactive about that. Every year, selling off some losses and selling off some gains. Cancel them out. So remember, retirement planning is not just investing your money. Be honest about where you are and where you want to be. Set goals, educate yourself, develop a strategy, inspect what you expect, and consult with knowledgeable, unbiased advisors. Make sure you know about our YouTube page. That's what it's there for. FPFEAZ, that's all of our future classes. Schedule them, get on the reminder list and all that stuff. And certainly if you want to meet with me for any reason, I do this for a living. I strangely love this stuff. It's all a big puzzle to me. And hopefully I was able to convey this tax planning in a useful way that you can then take it and look at your own situation. But if you want to meet with me for any reason, jump on yourinvestmentcounselor.com. You can schedule a free meet and greet or straight to an hourly if you want that instead. Always happy to help. 800 numbers up top here, and contact us at sesweb.net. Go straight to all of us. You can always email us anytime you need something as well.